What are my options as a business owner for raising finance? There are so many different types of loans and products available to businesses that it may be confusing as to what is the best option for you. In this video, we're going to run through the following 7 products in more detail to help unlock the best solution for your business growth and wealth creation. Standard loans, overdrafts, RCFs, rolling credit facilities, asset-backed finance, invoice factoring, supply chain finance, also known as reverse factoring, and credit cards. Stick around to the end of this video for some tips around understanding your business cash flow and how to best utilise these golden nuggets of knowledge you're going to learn from this video. Welcome friends, I'm Bradley, an entrepreneurial finance director and business coach with over 25 years experience working in various different companies and sectors. Whether you're looking to fund growth, seek finance to pay for capital expenditure, or raise cash to pay for an exit transaction, we should have an option here that will point you in the right direction for the type of finance you need to be looking to raise. Come with me as we run through the various options available to you. But before we do, don't forget to hit the like and subscribe button. Standard loans. This is the standard offering you should be able to get from your bank. Generally, this will be a loan amount which can be secured or unsecured, charged at an annual percentage rate, APR. The loan repayments will be made over a pre-agreed term ranging from 1 year to 5 years. These repayments are usually the same set amount each month, which helps with cash flow planning, so you shouldn't get any nasty surprises should you meet the monthly repayments. Bonus tip, if you have to put security behind a loan by signing a personal guarantee, then ensure you protect yourself with a personal guarantee insurance policy. In the unlikely disaster situation where your business defaults on the loan, this policy will kick in and generally pay up to 90% of the personal guarantee. Overdraft. An overdraft is a pre-agreed amount in which your bank allows you to go overdrawn into the red. Usually, this facility will come with an arrangement fee, and then you will only be charged a set percentage of any utilised overdraft amount once you go into the red. An overdraft is useful to have in place as a short-term get-out-of-jail-free card to play should your company come under short-term cash flow pressure. Just be careful to ensure you don't go over your pre-agreed overdraft credit limit, as your bank would charge a daily fee for every day you are over this, as well as an overinflated percentage of the balance. RCF, rolling credit facilities. An RCF is a useful facility to have and is a type of credit that does not have a fixed number of payments in contrast to standard loans. The way these work is that you would have a credit limit pre-agreed with the lender, let's just say for example 2 million. By forecasting your business cash flow regularly, you'll be able to see where the cash pinch points are and when this facility needs to be drawn on. This facility is flexible. If you only need, say, 1 million of that 2 million, then you can draw on just that 1 million. Then this million would also need to be repaid as a single bullet payment within the timescales you agree with the lender, say 6 months. During the 6 months, if you require extra, this can be drawn from the facility to top up the amount drawn down, because you still have 1 million over from that 2 million. Your lender typically charges an arrangement fee for setting up this facility, and then a small percentage of the unutilised amount of the 2 million facility. They then charge an additional percentage on any amounts that are drawn from the facility. This type of lending is becoming more common recently amongst lenders as companies have closer sight of their performance in terms of cash, profitability, and credibility. Asset-backed finance. This is probably the easiest type of finance to raise in a business. Lenders will secure the loan against an asset, such as a vehicle, a large item of plant, or a similar type of asset. Therefore, there is a reduced risk in providing this type of borrowing to a company. Just be mindful though, that should your business default on the loan repayments, then the lender will come knocking on your door to take away the asset that they have borrowed against. They would then sell this on to recover the amount outstanding at the time of the default. Invoice factoring. Invoice factoring is a way for businesses to fund cash flow by selling their sales invoices to a third party, known as a factor or factoring company, at a discounted rate. Your company would enter into an agreement with the factoring company whereby the factor will manage your sales ledger and credit control on an ongoing basis for a fixed period. The typical term of a factoring contract would typically be 24 months. In return for the invoice discount, the factoring company advances some funds up front when your company issues an invoice to your client, typically between 70 to 85% of the invoice. Then when it's time for your client to pay, the factoring company collects the debt and makes the remaining balance available to your business, minus their fees. Supply chain finance, also known as reverse factoring. This works similar to the previous example, but on the opposite side of the business, in relation to creditors or suppliers. This is a facility that optimises cash flow by allowing your business to lengthen your payment terms to suppliers, whilst providing the option for your suppliers to get paid early. This results in a win-win situation for the buyer and the seller. The buyer optimises working capital and the supplier generates additional operating cash flow, thus minimising risk across the whole supply chain. This facility is underwritten based on your own company financials and not your suppliers. So this is seen as a cheap way for suppliers to get paid early, even if their business is not performing so great. Credit cards. Corporate credit cards are the type of credit cards that business owners use and issue to employees. Whilst they operate in very much the same way as personal credit cards, corporate cards have different aims. Company credit cards give cardholders the freedom to charge authorised expenses such as business entertainment, travel and accommodation without needing to pay for the item themselves and then seek reimbursement. One of the most significant benefits of using a corporate credit card is how much easier it makes to manage expenses for both the employer and the employee. It also allows you to gain payment terms on expenses as much as 30 days, as the credit card statements are generated and paid on a specific day once a month. This is a major assistance to managing cash flow and is a massive improvement over paying with cash or with a debit card. I hope you've enjoyed watching this video today and you are now on your journey to the wealth creation station with your business and now know which finance facilities are best placed to help get to your destination. Don't forget to hit the like and subscribe button to this channel. Please feel free to view some of my other content, in particular this one here we mentioned at the start of this video about understanding your business cash flows. Here we run through the main elements of a business cash flow and help put together some detailed forecasts for your business, enabling you as the business owner to focus on the right growth strategies for your company. Thanks for watching and I look forward to seeing you again in the next video.